Hi everyone, thanks for watching today. Today we're talking about the financial statement basics, and I'm your instructor, Brandy. So today when we look at the financial statements, keep in mind that this is at a very basic level. So as you go further and further in the course, you're going to learn more about the financial statements, and you're going to keep adding and building on to the stuff that you're learning today in this tutorial. The financial statements that we look at today are also going to be for a sole proprietor. In financial accounting, we have four financial statements. We have the income statement, we have the statement of owner's equity, we have the balance sheet, and we have the cash flow statement, or the statement of cash flows. In this video today, we are going to be looking at the first three financial statements. We're going to be looking at the income statement, the statement of owner's equity, and the balance sheet. Whenever we're making financial statements in financial accounting, we always start with the income statement. We make the statement of owner's equity next, and then the balance sheet. And this will become very apparent in just a minute when I show you how to make these statements. So when we're talking about financial statements today, let's pretend that we have a bookkeeping company. And this bookkeeping company is called Sarah's Bookkeeping. Remember that the first financial statement we create is the income statement. And at the top of every single financial statement that we make, we are going to have three things. The first thing is going to be the company name, so in this case, Sarah's Bookkeeping. The next thing we're going to put is going to be the statement name. The first statement we make is the income statement, so let's write that. The next thing that we're going to write is the date or the period of time. An income statement is always for a period of time. So your income statement should either have for the year ended and then the date, or for the month ended and then the date. It depends what period of time you're looking at. For this income statement here, let's pretend that we're looking at for the year ended. So we're making an income statement for Sarah's Bookkeeping for the year ended December 31st, 2014. The income statement shows two major categories of accounts. It shows our revenues and our expenses. Remember, way back from our first video, the accounting equation, revenues are the amount of money we charge per hour or per project, or when you sell something, that's the amount you charge per product. The income statement shows revenues minus expenses to give you net income. A bookkeeping company is a service organization, so we're going to call this service revenue. And Sarah's going to have $10,000 worth of service revenue. The next major category of account on the income statement is expenses. Expenses are things that you have to pay for in the course of doing business. So your rent, your utilities, your phone, if you have to pay employee salaries, all sorts of things like that are expenses. So again, revenues minus expenses gives you net income. In this case, Sarah has service revenue of $10,000, total expenses of $3,000 to give her net income of $7,000. And I'm just going to put a little star beside this $7,000 net income number right here, because you're going to see on the next statement we make, we are going to use this number. That's why it's very important that we make the income statement first. So the next statement we're going to make today is the statement of owner's equity. So first thing we're going to put at the top is the name, Sarah's Bookkeeping. The next thing is the statement name, so in this case, the statement of owner's equity. And the third thing is the time period or the date. The statement of owner's equity and the income statement, their period of time should look exactly the same. So in our case, we were looking at for the year ended December 31st, 2014, the statement of owner's equity will be the exact same. The statement of owner's equity always has the five same things. Number one, the opening balance. Number two, investment by owner. Number three, net income or loss. Number four, withdrawals by owner. Number five, the closing balance of the capital account. We always make the statement of owner's equity second, and the reason for that is because we are going to use that closing capital balance on our next statement, the balance sheet. So pay attention to that $30,000 because we are going to use it on the balance sheet next. The next statement we're going to make is the balance sheet. Remember, at the top of financial statement, there's always the same three things. The company's name, the statement name, in this case it's the balance sheet, and the third thing is the date. Notice that we don't put for the period ended. The balance sheet has accounts that we just look at a point in time. The balance sheet is concerned with the accounting equation. So if you remember back to our video about the accounting equation, our accounting equation was assets equals liabilities plus owner's equity. And that's exactly what the balance sheet is showing. That's what we're trying to balance. We're trying to balance assets on one side and liabilities and owner's equity on the other side. Now we're going to fill in what goes into each of the categories. Remember back to our discussion about different types of accounts, that assets have a future benefit. So those are accounts like cash, office supplies, and equipment. And we're going to total up our total assets at the bottom to show how much assets we have. Liabilities are things that we owe to outsiders of the company. So accounts like accounts payable, notes payable, debt to bank, and so on. And since we only have one account in liabilities, we don't need to do a total. Then for our owner's equity section, we're going to go back and remember that number that we had for closing capital balance on December 31st. And remember back that was $30,000. And what we're going to put is the owner's name, so Sarah B, capital, and we're going to write the amount. Now we're going to take the total of liabilities and owner's equity and check, does it match total assets? And if these two match, total assets equals total liabilities and owner's equity, that means your accounting equation works and your balance sheet works. You are now allowed to do a happy dance. So now you should be able to create a simple income statement, statement of owner's equity, and a balance sheet. Thanks for watching, everyone. We'll see you next time.